All right, let's get right into it. For years, all we've heard is that Europe's legendary car industry is, well, basically doomed. But what if that's not the whole story? What if, in the short term, things look completely different? Today, we're diving into a fascinating paradox, an industry staring down an existential crisis that might also be on the edge of a surprising short-term boom.
This quote really just nails it. We're talking about the folks who gave us the Beetle, the Mini, the E-Type. I mean, cars that are literally part of our culture. But all that history, that amazing legacy, it's starting to feel like a liability. Like they're a heavyweight boxer in a race against a sprinter. The pressure is just immense.
So, to really get what's going on, we have to start with the crisis. This is the story you've probably heard a million times, the one about an industry that's on its last legs. And look, it's super important to understand this side of things, because this challenge, it is absolutely real. And this right here, this is the heart of the problem. It's a total clash of worlds. On one side, you've got Europe. It's all about heritage, emotion, that incredible engineering that takes years, sometimes a decade to perfect. And on the other side, the Chinese challenge. It's about speed, software, and this incredible vertical integration where they can pump out a new model in, 18 months? It's crazy. Europe is selling a feeling, an experience. The new guys, they're selling cutting-edge tech at prices that are just really tough to compete with. And if that wasn't enough, you've got what one analyst calls the regulatory straitjacket. Think about it. The 2035 ban on new gas and diesel cars is just around the corner. That means they have to pour billions and billions into going electric, all while trying to sell these pricey EVs to customers who are, let's be honest, still a little hesitant. And at the same time, they're up against rivals who get help from their government and control their own battery supplies. It's this massive, high-stakes bet with almost zero room for mistakes. So when you lay it all out like that, it looks pretty bleak, right? You gotta ask, is this it? Is the golden age of European cars over? Well, maybe not so fast.
Because this is where the whole story takes a really interesting twist. While everyone's been focused on the long-term storm, something else has been brewing. A huge and kind of surprising counter-story has started to take shape, and it all comes down to this: a massive regulatory plot twist.
And here's the key idea, what Bank of America is calling a regulatory reprieve. It's not just happening in Europe, it's a global thing. The US is easing up on EV rules, China's cutting subsidies, and, this is the big one, it's looking more and more likely that the EU's 2035 ban is going to get delayed or changed. Just that one thing, that one shift, completely changes the math for the next few years. Why? Because it extends the life of the thing that's still making them all the money, the good old internal combustion engine. And that brings us to Bank of America's big idea for 2026. They're calling it the ICE momentum trade. Basically, the thinking is this: the market has been punishing these car companies for this super expensive forced switch to EVs. But now that that pressure is easing off, there's a huge opportunity for their stock prices to get a rewriting. Basically, for everyone to realize they're worth a lot more. The big, scary threat hasn't vanished, but it's been pushed down the road. So, what does that actually mean for the money? Well, it's pretty simple. Less pressure to go all in on electric right now means they don't have to spend as much cash immediately. That protects their cash flow. It lets them keep selling their super profitable gas, diesel, and hybrid cars for longer. And for investors, it means these companies, which have been priced like they're going out of business, suddenly look like a bargain.
Okay, so if this whole idea is right, who are the big winners? Which companies are set up to really cash in on this delay? Let's take a look at who Bank of America is betting on.
So Bank of America has pointed out a few key players here. And you'll notice it's not just a buy everything situation. They're being selective. They like Porsche SE because of its unique setup, which gives you a discounted way to invest in the high-end market. They've upgraded Renault to a buy because they see it as a turnaround story that now has the breathing room it needs to work. Ferrari? Well, it's Ferrari. It's got that luxury armor. And even Mercedes gets a bump up because it seems like the worst might be behind them. And this is a great way to see the two different ways you can play this. On one hand, you have Porsche SE. That's more of a smart financial play. You're betting that the market will eventually wake up and realize the stock is worth more than it's trading for. Then you have Renault. That's your classic turnaround story. The company was priced for disaster, but now, with its gas-powered cars sticking around longer, it has the cash it needs to fund a smarter, more gradual shift to electric. But, and this is a really, really big but, we have to be crystal clear about this. This short-term opportunity, it does absolutely nothing to fix the huge, long-term problem the industry is facing. That threat from China isn't going anywhere. In fact, it's only getting bigger. Just look at this. This is the long-term crisis in a single chart. The market share for Chinese carmakers in Europe, it didn't just grow. According to Bank of America's data, it literally doubled in 1 year, from 2.5% to 5%. That's not a slow leak, that's a flood. And if that keeps up, well, the future for Europe's mass market brands looks incredibly tough. And it all boils down to this simple, kind of brutal truth, which BOFA'S Horst Scheider says perfectly. What people need is cheaper EVs. This whole regulatory delay buys them time, sure, but it doesn't solve the real problem for customers. People need affordable electric cars. And right now, Chinese companies are pretty much the only ones who can deliver them at scale. That's the gap European car makers are still desperately trying to fill. So you really have to hold two totally opposite ideas in your head at once here. In the short term, you've got some serious tailwinds for investors, a delayed ban on gas cars, more cash on hand, and the chance for these undervalued stocks to pop. But the long-term headwinds are just as strong, if not stronger. Brutal competition from China, the unsolved affordable EV problem, and a real squeeze on sales. All of this leads to a huge fork in the road for Europe's car industry. They've been given a bit of a detour, a temporary break from what looked like certain doom. But where they end up is still a massive question mark. So, where do they go from here? Well, based on some expert analysis, we can make a few educated guesses about the next 5 years. First, expect a shakeup. Somebody's going to merge or get bought out. There are just too many companies. Second, that 2035 ban, yeah, it's almost certainly going to be changed. Third, the market is going to split. You'll have the mass market brands fighting on price and the luxury brands selling their heritage. Fourth, the big fight for innovation is going to shift away from engines and move to software and user experience. And finally, Europe will build its own battery supply chain. It'll be late, it'll be expensive, but they have to do it. And all of that leaves us with this one big final question. The whole promise of a European car has always been about more than just getting from A to B, right? It's about passion, that feeling, a vehicle that moves your soul. In an age that's all about algorithms and cutting costs, can that promise actually survive? That is the real challenge for the road ahead.